Welcome back to the Money Show. A study by Securities and Exchange Board of India, that is SEBI, has reported that 9 out of 10 equity F&O traders lose money in the equity F&O segment. The average loss of these traders stood at rupees 1.1 lakh during FY22. So clearly, a lot of investors are usually unaware about the risk involved in the equity markets and do not really know how much risk then they can actually tolerate. So on the Money Show today, we will understand how you can understand the difference between the risk tolerance and your risk capacity. Let's welcome on board Aditya Agarwala, who is the head of research and investments at investforedu.com. Hi, very good evening, Aditya, and pleasure having you on the channel as always.
Hi, Shrishti. Thanks for having me on the show and good evening. Actually, a very interesting topic to talk about. Even I'm very excited and something which we usually don't address and we should address more frequently.
So let's get started, Aditya, then, because I'm not just going to be talking about the trading aspects, because definitely how to manage the risk over there, we'll touch upon that. But a lot of investors also get stuck because there's no certainty in the stock markets, and they start with maybe with the hope of earning some money and then eventually happen to be a long time investors in that particular stock. So how to get with that maze of investing as well in terms of risk tolerance, we'll touch upon that. But firstly, Aditya, before I come to the risk appetite, somebody who is actually looking to start its trading journey, rather, let's start with how should they come up with the capital needs. How should they take care of their capital needs as per you and as per your experience and the guidance that you have been giving to people? How much capital is adequate one to start your trading journey with? And then maybe we'll try to get your answer and how to manage the risk out there. Your take.
Yeah, Shrishti. So we'll start first. And this is also out of experience of 14 years that I've had. Not that I've not burned my fingers at trading. I have done so too. And over a period of time, I've realized that there is a way and a method that you approach trading and investing. You cannot merge both of them together. And when I talk about trading, the first and the main crucial point to be noted is when you should take a leverage and when you should not take a leverage, and whether you are in a capacity to take a leverage and whether you are not in the capacity to take leverage. If you're a fresher, if you've just started trading, like a lot of Gen Z after the 2020 market sudden rise, I noticed a lot of people entering the market, and especially they wanted to trade rather than make quick money rather than just invest for a long term. So for them, it's very important to first analyze how much to allocate for a trading. You should not start with leverage if you are a newbie in the market, and if you just started trading, if you barely have few months or maybe a year of experience, you should not start with a leverage, even though you can have the capacity and deep pockets, but I would strongly recommend not to start with a leverage portion. Now, again, if you have a corpus, say, for example, you have 100 rupees as your saving, and you want to take a punt in the market and you want to go with trading and investment. So at least 30% of your saving should be allocated to some fixed income and some secure investment sources. The balance 30% can go to a long-term investment product, which can be a mutual fund or your PMS, or even for direct stocks, a long-term investment. I would strongly urge not to go beyond 10 to 15% of your savings for trading, because again, here you are a fresher, you don't have much experience, and markets can be ruthless. Shrishti, we all know that. You sleep overnight with a position, and tomorrow all you notice is if you're long, markets can open with a big gap down, and if you're leverage, you're done with it. You have to quickly square off your position. So for starters, yes, you should not go beyond 10 to 15% of your savings, which should be allocated for trading. You should allocate more towards saving, and gradually, as you gain experience, you should build strategies, and then you should go about allocating more funds towards trading and zero leverage. Please don't start with a leverage if you're a new starter. For freshers, definitely it's a no-no.
Aditya, who is a full-time trader, also advises you that out of the whole saving corpus that you have, not more than 10 to 15% should go in something like trading. But Aditya, a lot of viewers, I believe, that they must be looking forward to you so as to become a full-time trader. But when it comes to the allocating 10 to 15% of the money, there are a lot many instruments where they can start with. And in terms of earning that quick money, what sounds more lucrative or what they find more lucrative is the option buying setup. So amongst all the three options, be that they are going ahead and investing in cash segment, or they are trading either futures and options, which one is the most riskier one, and how should they actually can manage their risk in along these three segments? What's your take?
So we'll start with the least risky option, which is your cash segment. Definitely, because if you have enough cash, you can buy the stock, you can sit on the stock, even if the stock is going down from your buying price, say a 5 to 10%, which again covers under risk management and risk tolerance and risk capacity, which we'll talk about a little later. You are safe there. You don't lose anything. Now, slightly riskier from cash is the futures market because there you have to pay up the margin money, and if the trade goes against your direction and your wish, you have to end up paying a margin to the exchange and then the broker. Now, the most riskier asset is options for sure. And this is where people actually want to venture out, and they want to make big money because clearly, if you're an option buyer, especially, you just have to pay premium, Srishti, and that premium could be as the cumulative amount of the premium could be 20,000 or 30,000. And people say, okay, with the 20, 30,000 kind of investment, I can take that kind of a risk. And even if it goes to zero, I don't mind losing 20, 30,000. In the process, what happens is you end up losing in lakhs, which the recent Savior reports also mentioned. Instead of recovering that amount, you end up losing a few 10 to 15 lakhs in the process of just buying option. So clearly, the most riskier asset class is option. I'm not saying you should not venture out for an option buying or a selling, but know the risks and the rewards that are attached with the option, and then maybe go for it. Have a clear strategy. Use it more as a hedging tool rather than just going for a naked option buying or a selling. You can do that if you have a proper clear strategy in mind, backtest the strategy, and you know what is the maximum loss that you're going to bear. Please do keep your stop losses in place, because again, any strategy cannot have an unlimited loss and a limited profit. So yes, coming from the asset class point of view, options are the most riskier asset classes.
Okay, but Aditya, now let's touch upon how much risk a trader can actually take, because in options, or rather in trading, you can't have every day to be a good day. I'm not saying that it's not possible, but generally we don't tend to find, because markets continue to be volatile, and that's the nature of the market, and that could be the nature of your portfolio as well. But in terms of earning money through market, one has to really get control of the risk that they are putting in, or they are willing to take, and then control their big losses. So in terms of any trade that they are taking in, how should they control their risk, and how much could be the maximum that could be a stake at any particular trade? What's your experience says on this?
So, Srishti, it's a very important take. And the best part about risk is, yeah, you can actually quantify the amount of risk you want to take in a trade or an investment. And the moment you feel that it is going beyond your tolerance or your capacity, you can actually cut your position, and then you can sit with the remaining cash and venture out again in the market, knowing again what is your risk appetite and your risk capacity. Now, these are two words, risk tolerance and risk capacity, which people usually use interchangeably, but they're not, to be very honest. And risk tolerance can be very high, but your risk capacity may not be that high. Now, again, risk tolerance is a subjective word, whereas risk capacity is very objective. It is measurable, and you can quantify what is your risk capacity. So just to make it more easy for our users, risk tolerance is the risk that you can take or you want to take, whereas risk capacity is the risk that you can take, what your current financial status and what your current financial position allows you to take. So just to give you an example, you want to start with 1,000 rupees investment and you take a trade using that 1,000 rupees. You might have that risk tolerance of going zero on that trade, and your risk capacity. But is your risk capacity allowing you to do that? If you go with 100% loss, you don't have any funds left to recover that loss again. So there is a big difference between risk tolerance and risk capacity. Like I mentioned, risk tolerance is subjective. Somebody can have a tolerance very high, and that will again depend on your age and your corpus. So give you an example. Let's take an example of person X. He is very young and he's just started earning and he's earning handsomely. Because he's young and he's still several years of working and earning left, he will have a higher risk tolerance. But that doesn't mean that he can have a very high risk capacity as well. Similarly, somebody who is already retired might not have that big a risk tolerance and a capacity both. So it's very important to understand the difference between the risk tolerance and the risk capacity. Risk tolerance is very subjective. You and I can have different risk tolerance. Similarly, you and I can have a different risk capacity as well. And we both can have a very high risk tolerance. Shrishti, you might be okay losing 50% on a trade. I might be okay losing 50% on a trade. But you and I can have a very different risk capacity. You might invest 5 crores, and even if you lose 5%, you are okay. I might invest 10 crores and I'm not very okay losing 1% of that. So our risk capacity could be very different.
As a thumb rule, do you follow any risk tolerance limits in a say that you cannot lose more than this percent maybe on any single trade?
Srishti, before entering a trade, the first thumb rule is I should know what my risk is. Before entering a trade and before even calculate what my reward is from a trade, I want to be sure of what is the capital that I'm willing to lose, and what is the capacity in a trade that I'm okay taking. Again, just to give you an example, I mentioned you should use 10 to 15% of the savings for trading. Now, you can't put all that 10 to 15% of your saving in one trade. It has to be staggered between several trades, because what if one trade goes wrong? You might end up losing a significant part of your capital with which you are using to trade. You don't want to infuse fresh capital every time. So the best thing is you demark what is the percentage allocation to one trade you want to do, and then you should also quantify the risk that you are willing to take and what is your capacity. So for me, Shrishti, personally, the risk threshold for me is between 7 to 8%. If the moment I see a stock losing 7 to 8%, I immediately make it a point to cut that position and then enter a fresh trade with a similar kind of a risk capacity. Now, again, your reward has to be something which will determine later. But before entering a trade, I always make sure that my risk capacity is in place. Though my risk tolerance could be very high, I could be very okay losing 50% in that trade, but my capacity is only 7 to 8% in a trade.
Before we let you go, before wrapping this discussion, just wanted your take that how should one keep control of their risk appetite in terms of investing? Because in the markets, we have seen a lot of examples where people go ahead and keep averaging out their losing trades. So what sort of a mental tolerance they need to have when they are stuck in such kind of a trade, and how should they go about it?
Again, a very important aspect you touched upon, Srishti. So let's start with a very important saying, which I also keep repeating: never average your losing trade, unless until you're very sure about what you're doing. Because what happens is the more you average a stock which is in a downward spiral, your average cost of buying will always be higher than the current LTP of that stock. Just to give an example, if you bought a stock at 100, the stock slides to 80, you average it out, your average price will be 90, the stock is still at 80. So you're losing 10 rupees on that stock. And with that, you have invested more funds to that stock. Now, if the stock slides further to 70 and you average more, the cost price, the average buying price will always be higher than the current market price. So you end up losing more and more capital if you're allocating to a losing trade. Rather, what you should do, you should average it out on the upside. This is very important because then your cost of buying will always be lower than the LTP of that stock. So it's very important to know when to average when to average a stock which is going down and when to not average a stock. Now, if you want to average a stock, say for example, you bought a large cap stock and you're very sure about the prospects of the company, but due to some reasons, due to the turmoil, external turmoil, due to the macro scenario, the stock market is correcting and your stock is also correcting. So when you're already aware of the fact that the stock is very good, but because of macro events and macro conditions, the stocks are correcting, you should not allocate all your funds in one go. You should always have a staggered buying approach, which is allocate 50% at current levels, wait for a downside, and you should also know till what time, till what price you are okay averaging the stock. There should always be a threshold to averaging a stock. You can't keep averaging on the way down throughout the time that the stock is correcting. So say, for example, you buy 50% at current levels, the stock corrects 10%, you allocate another 30% to the stock corrects another 5%, you allocate the remaining 20% to the stock. Now there should be a threshold level. From your buying stock has already corrected 15%. You can at max wait 10% more down for the stock to correct. If the stock keeps on correcting beyond 10%, you should also have a stop loss in place, which will minimize your risk and will take care of your risk taking capacity. Because as we mentioned earlier, your risk tolerance could be high. You could be very okay with the stock going to zero, but your risk capacity doesn't allow you because you will end up losing all your capital there. So it's very important to enter a trade knowing exactly what you want to do. If you have bought all in one go, do not average it out on the downside, rather have a stop loss. If you know that you want to hold the stock in your portfolio for the longer point of time, buy 50% at current levels and keep on averaging, knowing very well where your stop loss should be even after averaging.
Much, Aditya, for highlighting that how should one go about averaging if they're looking out at this one. But it was great having you on the channel, Aditya. I hope that a lot of viewers get benefited in terms of managing their risk in the correct way. That was it, viewers, how to go about managing your risk while trading or investing, and what's the difference between your risk capacity as well as your risk tolerance. But with this, it's once again time to slip into a short break, but don't go anywhere. We'll be right back.